revenue growth, very solid EBIT growth as well, which led to a much better operational bottom line performance as well. And to top those numbers, the company's given a guidance wherein they have maintained the FY24 outlook on constant currency revenue growth at 27 to 30% and EBITDA margin in the range of 19 to 20. EBIT margins would be obviously slightly lower. Sachin Tikekar joins in to talk about what gives them the confidence to do this in FY24 and what are the client conversations sounding like currently. Sachin, great having you. Thanks for taking the time out and congratulations on a good start to the year.
Thank you so much for having me, Neeraj. And secondly, thanks for the compliments.
Well, good performance, so deservedly so. Just tell us what went behind the 7.8% growth in the quarter. Was it continuation of the normal, or were there some specific activity that helped do this, clock in this number?
It's actually all the work that has gone in over the last couple of years, and some of the strategic relationships that we have built over the last couple of years. And we announced a couple of, as you would remember, with a couple of OEMs, we announced long-term engagements. And with our existing OEMs also, the business continues to sort of grow. All of that is coming together very nicely for us. And that gives us the confidence at the beginning of the year that we'll be able to hit that 27 to 30% growth guidance for this year, as well as staying between 19 and 20% when it comes to EBITDA. And just the way Q1 has panned out gives us greater confidence in sort of reinforcing our belief in the guidance. It's also fairly balanced growth, which is also what we are very happy about. It's balanced across our clients in different geographies. It's also balanced fairly across our offerings. And that gives us the confidence that, the bandwidth is balanced in that way.
Well, it's simple. You have to do more of what you did in quarter one over the next 3 quarters to reach the guidance. So shouldn't be that difficult for you. But here's the question. I mean, and I know IT services and ERD are different, but even in the ERD side or IT services as well, in particular, they're all talking of client conversations getting extended and in some cases deferred. Now, would you say, Sachin, that maybe that is happening for the discretionary part, and maybe in your case, your offerings are not discretionary in the strictest sense, and therefore you're not seeing delays, or are you?
Our conversations continue to be very positive, Neeraj. We continue to meet with our clients at the leadership level, and just conversations over the last 3 months since the last time we spoke have been very positive. I think they're a lot more engaging in the sense that their leadership is really trying to understand what is it that really, what does it take to make that journey towards case enabled through software-defined vehicles, and what are the learnings? This is the blind leading the blind. So we all need to work together and figure out how to make this work. From that perspective, and we continue to learn with every engagement, and that sort of gives us more insights that we can share with our clients. So the short answer to your question is our conversations have been very positive. They continue to be very positive. They continue to be very engaging. And from our perspective, we have not seen any kind of slowdown, given the kind of work that we are involved in at this point in time.
Okay. The new engagements as well, the TCV one is about $190 million. Is that an encouraging number? Would you have hoped for more? And does it look like more of the same can continue in the quarters to come? What is the pipeline looking like?
We are keeping our fingers crossed. But honestly speaking, we are very happy with the pipeline that we have. We continue to build on the pipeline, and that's something the momentum has been tremendous over the last several quarters. And there is no reason why we cannot continue to build on that pipeline and execute really well on the programs that we are actually signing up for. So we remain fairly bullish, cautiously optimistic. These are some of the learnings from the last 3 years. So the lesson is keep your feet on the ground and just get stuff done on day-to-day basis.
Yeah, I would reckon a lot of this, Sachin, is happening by, I mean, there is only as many new clients that you win, and of course, this universe is wide out there. But I reckon a lot of this is by deepening the engagement with the existing clients that you have, and expanding that mode. I'm just trying to understand what is the scope of this kind of work, because you've done two landmark engagements, and as we had spoken about the last time, a lot of the clients might be looking at this and thinking, how do they do something like this, if not exactly the same way?
Absolutely. So, first of all, it's with the existing clients. And the interesting thing is, the more we engage with them and understand their business problems, the better visibility we get in terms of what all are the areas where we can actually be of help to them. So it's all about, going in there, keeping your ears to the ground, understanding their problems and, some of the challenges that they're facing, and come up with solutions to solve those problems. And all of this has happened with the same set of clients over the last several quarters, Neeraj. And we don't see that changing because there is just so much more that we need to do with the existing clients.
Okay, interesting. Now, JP Morgan, in a note, Sachin recently highlighted that Honda announced a partnership with SCSK on software development for vehicles in areas of OS, etc. And their assessment is that the wallet share of Honda is now split between two vendors, you and them, which can, quote unquote, limit the upside for KPIT to expand its scope of work and wallet share. How would you respond to this?
Interesting observation from their side. The way we see it, Neeraj, we are ahead of our plan with Honda. And it's the same thing. The more we engage with Honda, the more areas where we think will continue to grow with them. And we continue to be very bullish on Honda, given the nature of our relationship and the way it's sort of unfolding. That's all that I can say. We really don't see any impact on our business, not only for today, but more importantly, going forward.
You're saying going forward as well, because I mean, the market would believe that, okay, is there an overlap between what KPIT is doing versus what SCSK is doing, etc. You were saying that even going forward, existing we had no doubt, but even going forward, you don't see the issue in scaling up your relationship with Honda.
I think the pie is so big and there is just so much to be done. We believe that our relationship will continue to thrive. We're fairly confident about that.
Interesting. Just so that we get this clarity, Sachin, because it's very difficult to get the clarity otherwise. And not every time we talk on a particular client, but because this is a large deal, am I getting this correct? That in your assessment, the pie from Honda itself is so large that you, even if there is this second player out there which is also doing some work for Honda, you can continue to grow much beyond your current engagement for a number of years with Honda alone.
Absolutely. Yeah, I think you captured it very well. That's exactly the message that we wanted to convey.
Okay, great. Okay, thanks for that, Sachin. Thanks for the clarity. Now, a word on margins. I mean, you've expanded EBITDA margins, EBIT margins as well. Significant expansion on the EBIT side, but you're guiding to constancy for the year. I mean, are you being conservative because there are some issues or challenges in the environment which might lead to either pricing pressure or employee costs uptick, what have you, because you've expanded your employee base as a fairly fast clip as well?
The reason, first of all, we are very happy that we are off to a great start in terms of the guidance. We're actually hitting the top end. Given the year, Neeraj, I'm not so sure about the pricing pressure or even the employee cost pressure to that extent that has been faced everywhere else. Those may not be the factors. To us, I think what is more important is now that we've reached this level, how do we continue to invest in our business, essentially our offerings and our markets and our presence, in order to create greater value for our clients? And that calls for substantial investment. And that's something that we will continue to do. As I mentioned earlier on, the more conversations that we have with clients, the more areas that we see where we can be of help to them. And that also calls for a lot of investment from our side. So that's something that we'll continue to do. Given this, we feel very comfortable with the guidance that we have given, and we'll stick to that guidance.
Yeah, and which is fine. Sorry, I'm not even trying to draw you into trying to say something that you don't want to say, but I'm just wondering, is there some room for error being left on the table? Because what you've done in quarter one could actually enable you to do the top end very, very comfortably, assuming that the same thing goes ahead. So is there some room being left because of the environment that we are in currently?
Not the current environment the way we see it,
Okay.
Neeraj, but some lesson learned from the last 3 years, right? Some macro things are beyond anybody's control, and we just want to make sure that we stick to our guns. But the bigger point is the continuous investments. That's the key for our growth and creating value for our clients. When there are just handful of clients, you want to make sure that you understand all their problems and solve as many problems as possible. And some of them are difficult because those are the problems that others cannot solve. That calls for a lot of bandwidth and a lot of investments and capability building.
Got it. Structurally, could it be a case that ER&D as a space could be facing structurally lower margins because of all that's happening in the pocket, or no? Part one. And part two, even if that is, or even if that may be the case, do you believe that at your end you would be able to maintain a band of sorts, or structurally over the course of the next 2-3 years there is a case for margins to even head lower?
I'll speak for our company, which is essentially being the software integrator to the OEMs. The way we see it, Neeraj, is over the next 2 or 3 years, we believe that the margins can actually go up gradually. Very slowly and gradually is what we really think. And we are sticking to that guidance. We want to be very cautious about the investments that we make, but we believe that in the immediate future or in the next couple of years, we don't see external pressure to lower the margins because of the work that we are doing. Having said that, now that's about us, specifically as a software integrator to the OEMs and the work that we are doing for the OEM. In general, for ER&D, there are two aspects to it. So there is software work, which is sort of higher end, which is in demand, which is what KPIT does. And secondly, there is the mechanical work and electromechanical work, and there are many other areas within the ER&D space. Obviously, all the OEMs will have to continue to save cost in as many areas as possible so that they can A, remain healthy, and B, have enough funds to invest into their future. And software-defined mobility or software-defined vehicles is one of them.
Got it. Okay. Sachin, one final word. I read a statement in your press release about how, and you mentioned this as well, that you're slightly ahead in the ramp up of the mega strategic engagements announced last year. Just trying to understand, was there a positive surprise or a large positive development that happened in the last 3 to 6 months that we haven't spoken, because I last spoke to you maybe about 5 months ago. So was there a large positive development or a positive surprise that happened in these engagements with the clients that gives you even more confidence?
So first of all, the two specific engagements that we've been talking about, Neeraj, I think there are positive surprises in the quality of the business, in the quality of the conversations, and the approach that they've taken of a true trusted partner with KPIT. So that's very important to us. That gives us confidence of building a long-term relationship. So that's definitely positive with the two specific clients. However, I want to bring up one part, because we keep talking about these two clients. There are others with whom we don't go out and talk about it for various reasons. Most of them we continue to have really incredible conversations, and bulk of the pipeline generation that you actually seen since the last time we spoke is actually back of some of the other T25 clients that we have, a handful of OEMs. So not only with these two, but some of the other T25 clients also, the conversations have sort of gone up the value chain, and we see more and more problems that we can solve for them. If that answers your question, Neeraj.
It does, and that's a happy spot to be in. So we wish you all the best for that, Sachin. Lovely talking to you. Congratulations on a good quarter yet again, and all the best for the quarters ahead.
Yeah, it's always my pleasure talking to you, Neeraj, and thank you very much. And hope to speak to you sometime soon.
Oh, most certainly. We would love that too. Thanks for taking the time out today. And viewers, thanks for tuning in to KPIT. They delivered a fantastic set of quarter one results. A good start to the FY24, and their guide to sticking to the original guidance of 27 to 30% growth for the year.